Hello, hello, hello. Welcome to Stock Trades. How's everybody doing today? All right, ladies and gentlemen. My apologies for the late live here. I was coding some things and we went ahead and upgraded a couple of the intrinsic values that we have. So in this video, we're going to go ahead and we're going to talk about OpenDoor. Now, the reason why we're talking about this is that a lot of folks have messaged me saying, hey, Al, do you mind if you go ahead and you cover the Q1 2025 results and, tell us what you think, given that you made a video about a week or two before their earnings. And I thought it's only fair to go ahead and, give my honest analysis. Now, for all that folks that don't know who I am, my name is Albert Allen. I'm the CEO and founder of Al Stock Trades, which is a data financial service software platform that it democratizes data to every country you can possibly think of. We have clients all over the world. And the thing about this is we don't like to do hype. We don't like to, the stock is going to go to the moon. We don't do any of that. So we're just going to go ahead and give a real honest analysis of OpenDoor. How are you doing? Excellent, excellent. Yes. So the $1 million portfolio. So if you go ahead and take a look at this portfolio, this does not include OpenDoor, right? I am not a holder of OpenDoor. And in this analysis, we're going to go ahead and build it together, and we're going to see, should I be a holder of OpenDoor? Should I not? It's going to be a complex analysis. The reason why people have reached out to me and wanting to just hear my opinion, again, I'm not a financial advisor. I have no certifications in finance. I've been investing in the stock market for 14 years, going on 15 years, and people just want to hear about how I look at companies. And, they come to me because I usually find publicly distressed companies that are mismatched between what they're trading in the stock market and what the value is. Like, for example, Palantir at around $6.50, SoFi at around $5, Clover Health around 60 cents. And the idea is, could OpenDoor have value? So we're going to go ahead and talk about that. We got a comment from Danny here. Thank you so much, Alan, for helping me set up my terminal. You're a great man, and I hope we can build a strong community here and a lasting friendship. I appreciate you, Danny. It was a privilege to be able to connect with you one-on-one on Zoom to help you integrate fully into the stock terminal. That's what we like to do, and now you have access to over 2.5 billion outputs of institutionally graded data. So don't mind me. I'm going to drink some coffee here. So obviously, as you can see, my performance has done really well. If you actually count just a few months ago before Liberation, the public portfolio is about $1.4 million. This is the public portfolio. We have a larger one with my significant other that has over 15 mil. We're going to be using this as a trajectory to pretty much capture the portfolio as we age into the 2026 and 2027 to see how it fares off relative to the S&P 500. Okay, so with that, like promised, like what we promised, we're going to go ahead and do a complex set of discussions regarding OpenDoor. We're going to look at OpenDoor stock forecasting book value per share using advanced financial modeling and decay analysis. We're going to go ahead, then look at the iBuying to the asset light real estate OpenDoor platform. Then we're going to go ahead and look at the Q1 2025 financial reporting systems. And we're going to go ahead and go through the statements to see and to nitpick things, which obviously this PowerPoint does. And then we're going to go ahead and utilize our software to go ahead and dig a little deeper. Okay. Very quick shout out now. We went ahead and updated the intrinsic value software. As you can see, it looks very beautiful now. And I've had a lot of concerns and questions regarding how to interpret it. Now I feel like it's a lot easier. It's to interpret. So very quickly, we could just look up, Clover Health real quick, stock that I talk about a lot. And you can look at, the base case. It gives you the intrinsic value, the stock price. This will be good because we will be calculating the price target of OpenDoor if they get into free cash flow positive territory. So when you see the stock price, you can see the intrinsic values here. So it's near undervalued. But if you go to the recession case, it shoots up to becoming overvalued with a margin of safety. Obviously, I don't think we're going to go to 146 because I don't think we're going to be in a recession. Bear case, you could see 276. Again, this is from its calculation here. Obviously, I think it's, I would say we could say 80, and then I would say 23. We calculate that, and this is the, look at the base case. Here's the intrinsic value now, $6.38, and then $3.19 is near undervalued territory. You go to recession, then obviously this pushes it to the more overvalued. You see how you read this, right? And then if you want, you go here, you go to the advanced matrix, and this gives you the overall range, $4 to $9, okay? Then if you want the whole scenario and the whole stack, you hit classic view, and it goes ahead and gives you the recession, bear case, base case, and best case. It doesn't give you the advanced matrix calculation, but it gives you a very sophisticated method in calculating. Again, this is all part of our software from the How Stock Trades software, which gives you hedge fund level analysis at the fingertips of retail investors. So there's the update. The goal now is we're going to look at open, right? And we're going to figure out the price target to see, what is ultimately OpenDoor worth, right? What is OpenDoor worth if we were to look at the calculation? I zeroed it out because, right now they're free cash flow negative, as you can see here. And we have to see ultimately what is going to be the free cash flow. Okay, so from that, we'll go ahead and just very quickly look at the technicals. Obviously, it's below the 200-day. If we zoom on in here, it's incredibly below the 200-day, sitting at around $1.55. The goal is now, are we going to get a turnaround? Is this going to turn around? And when is it going to turn around? Okay, so without further ado, let's go ahead and do our analysis here. And let's go ahead and do this here. Okay, so Dev, if you find a reason the stock is undervalued, I'll never forgive you. Oh, yes. All right, one open door, two closed doors, right? All right, so, wrong thing. So as promised here, we're going to forecast book value per share, looking at OpenDoor stock, as we said. Let's go ahead and activate the laser if we can. Is there a way? Laser. Then I like the color green. Can we get a green laser? That's fine. This is a nice laser. It's fine. Okay. So obviously by How Stock Trades, who else is going to be by? So the objective of this is to forecast future book value per share for OpenDoor from 2025 to 2027. And to do this, we have to apply historical data analysis and mathematical modeling to estimate trends, and to incorporate exponential decay, recursive functions, and adjust stabilization assumptions. Model designed to reflect professional grade predictive accuracy. Okay. Now, if that went over your head, don't worry. I'm going to go ahead and translate that in an easy to read, understandable language. But I'm going to first off, I have to show you how I got there, right? And let me explain. So if we go ahead and go to one of our software metrics here, one moment. Yes. Let me go here. And we're going to go to the Tri Financial Statements here as well, because that's going to be used. And we're going to go here. So if we go to our setup systems here, and if we look at book value per share, you can see book value on the quarterly basis for Q1 2025 is 89 cents, right? And you have to ask yourself, why is OpenDoor currently trading? What was the price? At 68 cents, when in reality, its book value is trading at 89 cents. So based off of these metrics, it looks undervalued from that angle, but there's a reason why it is trading at 68 cents. If you don't recall, watch my first video after this to get a full understanding, where I talk about why I'm looking right now at why I haven't put in $1 in OpenDoor. I'm currently waiting and watching, because right now the book value is still going down, right? And why is the market right now having a stock price of 68 pennies when it's around 89 pennies for book value? This is where this discussion comes into effect. So the book value per share declined, observed from $3.93 2022 Q2 to 89 cents, which we got from this discussion here. We could just respectfully pull this here. You could see $3.93 all the way to 89 cents. We're utilizing our software to go ahead and provide this data. This is a significant quarter-over-quarter contraction early on, followed by gradual stabilization. Recent quarters reflect a consistent decline of approximately 9.86% per quarter. From 2025 Q2 to Q4, projections based on the historical decay, we're going to utilize this to go ahead and use an improved model to go and average up the potential book value per share from 2026 to 2027. So the point is that what I would like to do is I would like to go ahead and look at book value, right? So so that's excellent that they raised that. And what I would like to do is I would like to look at book value to estimate it, because before I go to space, I want to make sure that the astronaut suit that I'm wearing, and before I'm, going out there, I want to make sure that I'm not going to fail and I don't want to lose money, right? So I do think online buying of homes is the future. No one wants to waste time, and yep, I agree. I do like the model, and we're going to talk about why it's just not working right now, right? A lot of people understand why right now, but we're going to go ahead and emphasize this, okay? So with that, to calculate this, we take the book value per share of the n minus the n minus 1 divided by the n minus 1 times by 100. This is used to compute the historical decline patterns of the average decay of the book value with the previous year divided by the previous year. This creates a mathematical basis for forward extrapolation. Once we do this, we can do a more sophisticated model to smooth it out by taking the sigma, which is the sum of all of the quarters of quarter one in comparison with the quarter one comparison to the quarter before, and quarter two comparison with the quarter before, et cetera, divided by K, which is the number of quarters annualized. And when we go ahead and when we do this calculation, we get R is equal to negative 9.86%, improved to negative 7% for 2026 to 2027 to reflect possible stabilization. So when we forecast this model, and I'm gonna show you what it's gonna say. Again, I don't like the hype. I like to explain the mathematical modeling. Then we could go ahead and explain what's going on. If R is negative, this model is a geometric decline. So you go in and you multiply by 0.93, which is showing a negative 7% decline, which is 100 minus 7, which is equivalent to 0.93, which is 93%. This applies compounding loss similar to depreciation models in financial theory. By going ahead and doing that, you take the book value per share of 2025 for Q4, and the way to do that, you use this forecasting modeling, which is a recursive logic, which builds a projection, which is dynamic, which obviously will change as we get more data from Q2. If you want to go ahead and be fancy, you could go ahead and use a logarithmic model by looking at the book value per share. Again, for all my mastering stock market students, this extends beyond the scope of the discussion of mastering. Later on, we can talk about this later, but I wanted to make sure if I'm making a video on a stock that is depreciated by a lot, I want to make sure I'm using the best mathematical practices to figure out what the book value per share is going to be. So you do phase one, which is based on historical 9.86%. Then phase two, you have to do an improved scenario, which I gave him the benefit of the doubt, given the CEO was talking about how they're going to be improving operationally. So the transition, though, if you do the analysis, will go from 89 cents to 36 cents. And that's a bit scary, right? So to do this in Excel, you can do the rate of decline. You could just do the B2 value, and you can go ahead and do it yourself in this calculation, but we'll go and do it for you. And the point is, the point of me showing you this is this not guesswork. This is data-driven financial modeling using compounding rate decay analysis and predictive trend optimization. The same tools used by Wall Street analysts. You could have saved tens of thousands of dollars if you have seen this early. Imagine doing this a year ago. You would have been able to be like, okay, this thing's still declining. I don't want to get into it. So you go in and you do the decline. So for Q1, the book value was 89 cents. For Q2, I expect the book value to be 80 cents. For Q3, I expect the book value to be 72 cents. For Q4, for this year, I expect book value to be 65 cents. Now, here's the interesting thing. Wall Street is smart. They're doing the same modeling, which is why the stock price is right now trading at 68 cents. Specifically, it's trading at 65 cents, which is at the overall Q4 2025 arithmetic mean of the book value per share calculation utilizing our logarithmic models. So as we get closer through the year, we're approaching Q4 2025, unless they show us a surprise in which they're able to be profitable, right? Based off of this year, all I see is EBITDA profitability. I still see negative net income. So its destiny and its fate is going to be met by what you see in this representation. My fear is as we get closer to the year, Wall Street is going to say, okay, well, we'll go ahead and push it out 4 more quarters. So right now, 4 more quarters is equal to Q4 2025, which is 65 cents, which is equivalent to the 52-week low. If we get this Q2 and it's 80 cents, they're going to push it out 4 more quarters, and it's going to get a new low of 61 cents. Then Q3 will push it out 4 more quarters, and we're going to go to 56 cents, 52 cents, 49 cents, unless this arithmetic mean calculation is stopped. The only way we could stop this destiny of going to 36 cents is by them being able to fix this decline. How is this fixed? Well, they have to go ahead and add shareholder equity, right? Because the way book value is calculated utilizing our proprietary software, it is book value per share is equal to the total equity divided by shares outstanding. And if we go ahead and look at our tri-financial statements and open up here, and if we go to balance sheet here, and we go to total equity is calculated by total assets subtracted from total liabilities. So they need to go ahead and either decrease their liabilities or increase their assets, because ultimately that will be divided by shares outstanding. And the only way to increase that total equity is to be able to make more cash, be able to be positive net income, be able to essentially take that net income, take it to the statement of cash flows, and be able to be free cash flow positive. So, based off of what I'm seeing in what we're saying here is, right now I am watching. I'm watching right now and looking at its destiny, and the only way this destiny will change is it needs to, reverse. This needs to reverse course. Let me explain to you on how a reverse course looks like, ladies and gentlemen. If you go ahead and type in Clover and go ahead and go to quarterly, look at free cash flow. Look at book value. It went from 90 cents, 82 cents, 73 cents, 67 cents, 69 cents, up a little bit, but down to 67 cents, 59 cents, 60 cents. All of a sudden, it starts to change. 67 cents, 70 cents, 69 cents. It rebounded. And the only reason why it dropped in Q1 in 2025 was because they had an operational cash flow due to unpaid claims and working capital issues, but more specifically to unpaid claims. And the fact that they used approximately 18 plus 13, over like $30 million of cash to buy back their shares. 18.2 million used to repurchase, and the other one used cash to offset the taxes, and they just kept the treasury stock rather than just selling the treasury stock, right? Which occurs as the contra equity account, which removes from the balance sheet, right? So the point is that you got to look for the ability for OpenDoor to reverse. And as of right now, I don't see that. So this is by far a very dangerous investment. And I am not going to put $1 into this investment until I see some change. This is incredibly risky and it's incredibly dangerous. Let me explain why. But here's the thing. I don't think it's going to go bankrupt. And I'm going to explain why, because of the assets and liabilities, right? But what I do, and we will calculate their value right now. But what I'm scared of, ladies and gentlemen, is very simple. If I'm buying the stock right now, based off of this modeling that we have, this thing looks like it's going to get decreased by half if they don't change course. And that's very dangerous. And it looks to me as management looks incompetent, right? Because they should have seen the writing on the wall, right? So I'm a bit worried when it comes to this because, you know, this could drop more because the book value is depreciating. And as the book value depreciates, what's going to happen? How long could it stand in the stock market under $1 without doing a reverse stock split? And the issue with the reverse stock split is it comes with negative connotations, and then retail investors get shaken out and they essentially sell off. So one thing I would like to add, if I may, look at Morgan Stanley. They decreased their position in ownership. Look at Renaissance Technology. They decreased, by the way, I like Renaissance. Jim Simmons, RIP. They decreased their holdings. Goldman Sachs slightly decreased their holdings. UBS slightly decreased their holdings. Likewise, I would like to add before going back to the presentation, if I may, if we go ahead and open up our quantum charts, which is part of our software that we have from alstocktrades.com, if we go ahead and do that, and we log into institutional ownership, which is using our proprietary analogs and methods, which is only exclusively available to hedge funds and institutional investors, if we score, hold on for a sec. Let me go ahead and the issue is sometimes I got to restart my computer. I do a lot of coding and whatnot. And sometimes the computer gets tired. So let's go ahead and redo this. And this time, let's score it. If we score it, you get a bullish matrix of 2 and a bearish matrix of 7. Overall bearish. So institutions right now are bearish when it comes to OpenDoor. Ladies and gentlemen, life is simple. A lot of discoveries go back to the 1980s. There's a guy by the name of Stein Weinstein. He created a thing called stage analysis. And it's very simple. You can apply stage analysis to anything. I have some discoveries I wanted it to apply to regarding the clinical examination, but you can apply this to anything in medicine, measurements, and everything. In this case, it's stock price, right? In the case that we have in our institutionally graded data, it's institutional investors. When we do this, life goes in sequences. We have the moving average here, which is the 200-day. Back in the day, in the 80s, they used to call the 30-week, equivalent to 200-day. We have the stock price, which is in black. It goes above the 200-day. We've entered stage 1 and stage 2. That is the bull market. Stage 3 is the topulation of the bull market, which then goes down. Stage 4, which breaks, and this is the dangerous zone here, okay? So, for example, if we go ahead and go to Clover, you can see from this angle, here's the red line, which is the 200-day. It broke out of this, and it failed the test, and it kept on going lower and lower and lower until something interesting happened. It became positive free cash flow on a quarterly basis in a continuous. And Q2 was it was positive net income in 2024. It broke out of the 200-day moving average. And now it's in stage 1, stage 2. And the battle cry right now is stage 3. It's currently at stage 3. The thing is, can it hold? And that's where everyone's scared of. Luckily, there's something called intrinsic value calculation. You can't use technical analysis without its intrinsic value counterpart, right? A stock wouldn't be traded in the stock market without it being able to create revenue and net income and free cash flow, which is called fundamentals, right? The purpose of a business is to invest in something that be able to basically capture market value. The issue, as discussed with OpenDoor, is it's way below its 200-day. You can apply the same analysis to investor holdings. What I like to do, as you can see, is they're all below the red line. The red line is the simple moving average. Investor holdings, currently right now about 273 holders. It dropped from 297. Institutions are selling OpenDoor. Number of shares decreased from 376 million to 353 million. Institutions are selling OpenDoor. Ownership percent has decreased from 53% down to 48.84%. The way we calculate ownership percent is we use Class A and Class B outstanding shares, which is the most accurate way of calculating it. If we were to go ahead and look at the long range, you could see right now, if we were to blow up the graph and just stop the comments for a sec. You guys can still comment, but it's not going to show up on the screen. You can see that right now, investor holdings is in a negative downward spiral. Likewise, number of 13F shares has decreased, and it's currently in a stage 3 and stage 4 analysis. I would like to catch it here, but institutions have not shown me that it's there yet. Likewise, total invested is down, which is counterintuitive because the market cap is going down as well. Ownership percent has been decreasing. It went as a high 78 and it dropped below. Who's essentially holders? Retail. New positions. New positions are unfortunately at a downward low. Increased positions are still slightly changing, but overall, if you take a holistic picture here, it's still bearish, as you can see from the scoring system. Reduced positions has decreased, which could signify a potential bottom, but still, that's just one positive marker that I've seen in a sea of red. Total calls are down, total puts are down, but if you were to take the calculation, the put levels are above 1, currently 1.5, indicating high put to call ratio, showcasing that institutions are short OpenDoor. Likewise, this short has decreased, but it's still above 1, indicating that institutions are still short OpenDoor. As you can see, if you look at analyst price targets, you can see OpenDoor's medium price target is around $1.75. Let's see if we can calculate the value, but first let's go back to our discussion. For folks that are watching, you can see that I'm very data-driven. I have no emotions. Everything that I presented to you is all backed by data. I am just a receiver of the data. I am just talking about the data. Everything I do is data driven. There's no emotion. It's all data, right? I'm not going to go into a burning building if I know it's burning, right? A quick plug for individuals that would like access to our software and to our members that have over $44.5 million. This is our proprietary intrinsic value calculation. Imagine if you would have had access to this information, access to this level of knowledge. Imagine how much money you would have saved. For folks that are interested, we have lifetime access. Use coupon code SAS, SAAS, for $1,200 off. Going back. As always, this is our disclaimer. We are not financial advisors. We're not a stockbroker. This is an educational platform. Going to our next discussion. Let's exit presenter mode here. Now let's go ahead and take a look at this. Now we're going to look at its business model. Here's our disclaimer. So we're going to go ahead and look at the company overview, the iBuying model, the evolution of asset-light model, the current operating strategy, key financial metrics, and strategic implications and outlook of OpenDoor. OpenDoor is a digital real estate platform that aims to simplify home buying and selling. Founded in 2014, core mission, simplify real estate transactions. Key offering, instant cash offers for homes, iBuying. Traditionally, iBuying model. OpenDoor buys homes directly from sellers, conducts repairs and improvements, resells homes on open market. Revenue from resale price relies heavily on capital for inventory. There's a high capital intensity. There's limitations here. Exposure of housing market volatility, operational complexities with repairs and turnovers, and margin pressures that are in the downturn. Shift towards asset-light model. Reduce home inventory risk. Expands listings via List with OpenDoor. Launch marketplace for off MLS listings. Refer out of buy box customers to agents. Monetize through fees and commissions. Unfortunately, for all the people that are experts in OpenDoor, if you can please, what are the specific gross margins of this business? I tried looking and I was not able to find it in my preliminary study. What, in my questions that I have for the company, is based off of your asset-light model approach. What is the revenues from this business model that you're talking about? What are the gross margins? Is that segment of the business profitable? The unfortunate part is, since I'm not able to find answers, it may not seem that this is a big issue. Like, it's not a big part of their revenue. So we'll be making videos on SoFi. Follow us, right? And then we have our analysis in our stock terminal. If you would like, no pressure to be able to join our platform. If not, totally understandable, right? Excellent. Yeah, housing is very complicated. So they're saying it's around 85%. Now, have they given us the numbers for that? How much is the revenue and how much is that scaling? Right? How much money are they making from that? Now, how the asset-light model works. Cash offers remain core product. List with OpenDoor. Sellers list with a partnered agent. Marketplace, off-market listing exposure. Agent referrals. Match out-of-scope leads with agents. Generates revenue without home ownership. Right? You see, 8 to 9%. That's tough, right? So, this is the big issue. Okay. But if they are able to do this slide gets me excited, right? I need to see this. I need to see this turnaround. Now, very quickly, Peter Lynch, one of the great investors I look up to, says one thing. when it comes to business turnarounds, you don't have to enter early. You can wait. You can wait and watch. Watch for a turnaround. As of right now, I don't see it. We have the EXP Realty integration, 70 plus thousand agents, agent-led listing and pricing adjustments, referrals to vetted agents from Open Doors funnel, partner-driven acquisitions, now a major volume channel. Operating strategy focused on margin optimization over volume. Flexible marketing spend aligned with seasonal spreads. Spread pricing to manage risk. Improved conversions via price segmentation and agent assessments. Ongoing cost discipline and reduced fixed OPEX. Operational expenditures. Key financial highlights for Q1 2025. Revenues $1.2 billion. Contribution margins 4.7%. Adjusted EBITDA loss $30 million, year-over-year improvement. OPEX down 33%, acquisitions 3,600 homes approximately. Position. So what is the strategic implications and outlooks? Positioning as a multi-channel platform. Asset-light model offers scalability with less risk. Strong cost discipline provides path to profitability. Macro headwinds remain though, but model increasingly resilient if they can prove it through showing me the money, showing me essentially the net income, showing me the free cash flow. These are my disclaimers for these presentation slide deck. Now we're going to go ahead and look at the Q1 2025 financial report. These are my disclaimers. Ladies and gentlemen, key financial highlights. Revenue, $1.15 billion, up 6% quarter over quarter, down 2% year over year. Gross profits, $99 million, up from $85 million in Q4. Positive development. Net loss, negative $85 million, improved from $113 million in Q4 2024. Again, positive development. Let's go ahead and let's double check here. Net loss, again, a negative 85 from 109. We're using this number, but it's good to use this number as well. Adjusted EBITDA, $30 million, improved from $49 million. And likewise, here's your adjusted EBITDA, $30 million, and it's an improvement from 50. So they're slowly on their way to profitability, but still has not yet gone there. Home sold, 2,946 versus 2024 Q4, 2,822. So they increased homes. Likewise, if you look at Q1, 3,078. Unfortunately, the home sold has decreased from Q1 last year to this year. So the selling of their homes has decreased, unfortunately. Homes purchased. They purchased 3,600 homes approximately. Q4 2024, they had around 2,951 homes purchased. But if you compare it from last year, Q1, 3,458. So they have an increase in homes purchased. No, this is not. This is related to the title, which is Open Door. Strategic and operational updates. Inventory increased to 2.36 billion, which is 7,000 homes, 9% growth Q over Q. Could be a double-edged sword. More inventory enables sales, but also carries a carrying risk. Excellent. So it went up. The problem is that this could be a carrying risk. New listings under contract declined 60%. 60% drop in homes under contract signals a sharp slowdown in future inventory and sales momentum. Ladies and gentlemen, this is a big red flag. 27% of homes on market greater than 120 days, up from 15% year over year. This is a red flag. Suggests homes are not turning over quickly. If you go here and go, there's 27%. If you compare it to last year, again, we like to compare quarter over quarter. Unfortunately, homes through this season are sadly longer than anticipated. Focus on evolving from iBuying to broader selling platform. Platform now offers both cash offers and agent listings. Revenue fluctuates. Peak at 1.51 billion in Q2 2024, now 1.15 billion. Net loss have narrowed but persists. Gross margins improved to 8.6 from 7.8% in Q4. Contributing profit per home, 18.32K in Q1 2025 versus 18.51K in Q1. I went ahead and calculated this for us. What this suggests is that unfortunately it's decreased. They're less profitable per home, per transaction. Not by a lot, but it's still going down. I'd rather it going up. So contribution of profit per home dipped, signaling mild pressure on resale margins despite improved efficiency somewhere else. And that could be the asset-light model, potentially, that I'm thinking about, right? Inventory and home purchases growing again post-Q4 slump. So first principles analysis. Core engine, acquire homes below market, add value, resell. Success depends on pricing accuracy, fast turnover, cost, and control. Profitability requires scale and margin optimization. Inventory turnover is critical. Aging inventory is equal to capital risk. Q1 signs that inventory aging and margin stress easing. So there could be some light at the end of the tunnel. It's just too early to see. From a hedge fund perspective, improving EBITDA and narrowing net loss shows operational discipline. Contribution margin recovered from 4.7% versus 3.5% quarter over quarter. Significant cash on hand, $559 million from $671 million. And it's, as of now, the market leader in tech-enabled real estate transactions. The unfortunate part of the concerns is there's persistent net losses, raises sustainability questions. What's troubling for me is the inventory growth plus higher aging risk of 27% greater than 120 days in inventory. Declining in new homes under contract suggests softening pipeline. High debt load with $2.1 billion in non-recourse plus $378 million in convertible notes. Yep, that is true. Q2 guidance, 1.45 billion to 1.52 billion. Solid, substantial growth. Contribution profit, 65 to 75 million. Adjusted EBITDA, 10 to 20 million, break-even zone approaching. So the big thing here is, could they be positive in EBITDA next quarter? Could Q2 guidance suggest that they are going to be positive next quarter? So the big thing here is, if you look at here, let me read this really quickly.
OpenDoor has not provided quantitative reconciliation, forecasted contribution profit, forecasted gross profit, loss nor reconciliation, forecasted adjusted EBITDA, forecasted net income, loss within this press release because the company is unable, without making unreasonable efforts to calculate certain reconciling items with confidence. These items include, but are not limited to, inventory valuation adjustment and equity securities fair value adjustment. These items, which materially affect computation, forward-looking gross profit, loss and net income, loss, are inherently uncertain and depend on various factors, some of which are outside the company's control. For more information regarding non-GAAP financial measures discussed in this press release, please see use of non-GAAP financial measures following financial tables below.
So based off of this, ladies and gentlemen, the big thing here that garnered my attention is the Q2 2025 guidance. We had contribution profit guidance of 65 to 75 million and adjusted EBITDA, which is guidance of 10 to 20 million. Now, first off, you talk to Charlie Munger, rest in peace. Adjusted EBITDA is another way of saying bullshit. However, it is closer to some form of profitability. Like I told you in the discussion that I have right here. Like I told you in this discussion, ladies and gentlemen, the goal right now is for them to break this fate. How can they break this fate? This is a bad direction, ladies and gentlemen, okay? How can they break this? Well, if they're profitable, if they somehow are able to generate free cash flow. If it so happens that Q2 does that and they give us a Houdini then potentially, this may lead to a positive jump in the stock price. Again, hard to gamble on, right? But based off of this, it does offer some hope. But are they reconciling that the Federal Reserve may decrease interest rates? Potentially so. But as you can see with the bond rates right now, they've gone up, with some forms of individuals suggesting that it could be a purpose to increase rates, which could further impact this business model. So this is something to look forward to. As of right now, the stock price is pricing in Q4 2025 at 65 cents. There could be a jump if they are met with positive discipline. It could jump back up to 80 cents to 85 cents and potentially 90 cents if what they say in this statement comes true. But again, we still have Q3 and Q4 discussions to talk about. January 2025 neutral rating amid macro headwinds. Macroeconomic issues like high mortgage rates and low home sales pressure near-term growth. Scale and data aggregation provide long-term advantages. Home acquisition fell 27% in Q3 2024, and Q4 of 2024 guidance shows margin compression, which is not good. Will this margin compression happen in Q4 2025? Valuation appears low, but risk-adjusted returns remain unattractive, which unfortunately yields me to be neutral in a standby and wait. Key trend and strategic risk. Persistent macro headwinds, rates, affordability, and liquidity. Thin margins and slow inventory turnover limit earnings potential. Structural issues in iBuying business model, low adaptation and high cost. Financial runway in 2026, but no break-even trajectory is evident. Reliant on market recovery or significant operational innovation. That's the issue right now. For the bulls that are in OpenDoor, they are reliant on market recovery and significant operational innovation, such as this asset-light model, not the continuation of the business model. The business model is broken, and they need to find a way to fix it. Conclusion. Short-term high risk, weak housing market, operational insufficiencies. Long-term potential upside if iBuying adoption increases and macro improvement. Monitor mortgage rates, home sales, and OpenDoor's pivot to strategy. Current stance, avoid new investment, reassess if macro environment improves significantly. So that's the stance from this analysis in this point of view. As always, these are my disclaimers. I am not a financial advisor. I'm not a stockbroker. I'm not licensed in anything in regards to financial advising. I've been in the market for approximately 14 years, going on 15. I created a software that has over 2.5 billion outputs of institutionally graded data, the Al Stock Trade software, which gives you access to what hedge funds and institutional investors have. Okay? I appreciate you. And we put it in a way that's in a very professional format that has no hype. Strategic analysis of data, no emotions, purely looking at numbers. A lot of folks look at us and they say, well, you know what? We called out a lot of stocks. HIM's at 24, Palantir at $6.42, Clover at 60 cents, and they see our returns in the market, right? And they see what we do is actually working, right? Very quickly, OpenDoor, as of right now, year to date, is underperforming the market by 57%. A year, down 69%. 5 years down 93%, and obviously the same thing because it hasn't been awake that long. Okay. Very quickly, for all my lifetime access members, we now are in 44 countries and 60 plus stock market exchanges around the world. We have access to billions of data points. We are in Argentina, Australia, Austria, Belgium, all of these countries, right? Any stock market you want, enter the ticker code and you'll get access to it. In regards to credit risk spread, we believe that a recession is a not so high case for 2025, given the high yield credit spreads is not as big as what might one expect. We talked about these institutions selling. Now, let's go ahead and do some calculation. So free cash flow, down negative 16.48 million on Q1. Q1 last year was positive 25.49 million. Issue is they probably sold some inventory. Net income was down negative 9. Oh, wait, sorry. This is open. This is Clover. My apologies. I'm like, well, this looks too good. Okay, free cash flow down negative 283%. You see how I immediately know I'm like, that's not correct. Down negative 283 million from Q1 2025. Right? Q1 2024, unfortunately, free cash flow is a lot worse. Net income down negative 85 million, which is a lot better than negative 109 million. As you can see, it was some form of a positive turnaround in 2022, but unfortunately, it depreciated into a negative story. Working capital is slowly going down. I'm analyzing. Looking at our enhanced AI analysis. This is our generative AI, actually. Let's go ahead and do one thing here, if I can. Let's open up the enhanced AI analysis and let's look at let's look at the quarterly. All right, quarterly. All right, that's a lot better now. Okay, quarterly. Gross margins. Sadly, from last quarter, went down. So we got a decrease in gross margins off of the top, unfortunately. Operating income slowly got better. Operating margin slowly got better. Net income improved only by one standard deviation, 22%. Earnings per share only improved by 25%. You got an increase of 6% shares. So we got some dilution, which is 64 times the standard deviation. Dilution went from 682 shares to 723 shares. So you got a 6% dilution. Book value per share, unfortunately, dropped by negative 32%, which is 9 times the standard deviation. Operating cash flow, unfortunately, fell by 56%. Free cash flow fell by 52%. Free cash flow per share fell by 44%. Working capital, unfortunately, fell. So based off of this, it does not look good to me. Analyzing the enhanced AI analysis from our proprietary software. Operating margins, unfortunately, fell from the 2020 fiscal year to 2023. Operating cash flow flipped and unfortunately went to negative. CapEx dropped, which is good. Free cash flow, unfortunately, flipped negative. Again, not good at all. Going ahead and activating the enhanced AI analysis and generating insights. We're synthesizing strategic financial intelligence, utilizing our artificial intelligence models to go ahead and look up OpenDoor Again, we use high sophisticated software that is only accessible to hedge funds and institutional investors. Now it is accessible to retail investors around the world. We go ahead and distribute and democratize financial data to investors around the world, leveling the playing field between Wall Street and retail investors, Main Street. As this loads, there it is, it's loading. It's loading the financial intelligence and generating the AI model. Again, for individuals that would like access to our platform and get access to this AI add-on, we have the platform that can change your life and help you become a multimillionaire. I went from homelessness to becoming a multimillionaire, right? We offer no hype. We offer pure, fundamental analysis from an educational perspective. Final rating from the AI model, hold, high risk. Potential for turnaround, but requires stronger execution. Immediate focus, prioritize quarters with revenue growth and positive cash flow as a key indicator for future potential. Unfortunately, they have not achieved that, which is why we have to continue watching. What worries me is institutions are slowly slowing down and they're not buying, they're decreasing. So that could be an issue. They could potentially see a future reverse stock split in the distant future if they don't change their fate with book value per share. There could be some light at the end of the tunnel for Q2's guidance, given what they're suggesting. But it's too risky to tell, as it's very cloudy, to determine whether this is a strategic investment or not. I'm analyzing. Declining revenue, persistent losses, and weak working capital may pressure the stock. Yep, not good. Very quickly, for individuals that are part of our lifetime access and part of the generative AI platform, I would like to add something, or a couple things I would like to do. Yeah. Please go ahead and update enhanced AI analysis to follow through the generative AI model and update it in the cloud base. That's a reminder for myself. All right. So with that, we went ahead and analyzed that. Now let's go ahead and go to the financial statements. There it is. Excellent. So as of right now, we'll go ahead and reload this. Very quickly from a top line perspective. Looking at the balance sheet, total current assets is 2.9 billion. Total current liabilities is 529 million. They have enough to satisfy the short-term debt obligations. Also, we're going to be going ahead and updating the financial ratios. We're just doing a couple more things, and that's going to be very helpful to calculate the current ratios and all the other ratios needed to be successful in analyzing the stock. Furthermore, total assets, 3.1 billion, total liabilities, 2.4 billion. If we were to look at this, unfortunately, the assets and liabilities has decreased At least they've decreased somewhat proportionally. If we were to go ahead and subtract total assets as of right now, 3126 from a fiscal year basis of 2413, we get 713 million, which is exactly what this is right here, which is total assets subtracted from total liabilities. We are an educational platform, which is why we have definitions here. So individuals can go from zero to hero and being able to master the destiny in the stock market and have an edge like no other, rather than someone who's on Robinhood who does not have access to this data, right? Because a stock does not equal the business, and the business does not equal the stock. In the short term, a stock is a weighing machine. Sorry, in the short term, a stock is a voting machine. In the long term, it is a weighing machine. And the weighing is the estimation of positive future free cash flows discounted back to 10 to 15% using a 2 to 3% perpetuity model divided by the number of outstanding shares. Okay. So now let's go ahead and look at the accurate data. Let's look at the quarter. Total current assets is $3.1 billion. Total current liabilities, $1 billion. Unfortunately, total current liabilities increased by 500 million, which is not good. Total current assets now over total liabilities is 2.6 billion. So now we take 3277 minus 2632. We get 645 million. Currently, Open is trading at 496 million, which is a discount from its already equity value of 645 million, due to the fact that the stock market and Wall Street is anticipating a decline in book value using the modeling systems that we showed you from a logarithmic perspective in the beginning of the video. Okay. Looking at this perspective, it seems to me as liabilities are catching up into assets. Ladies and gentlemen, if liabilities catch up into assets, it can become incredibly dangerous. This is something to watch for. In the interim, total current assets is 3.1. Total current liabilities is $1 billion, which means that what is total current liabilities? All short-term obligations due within a year. The unfortunate part about this is that if that's the case, that they're about to remove $1 billion from their assets. That is not good. If they do that, it'll be dropping from 2.2 billion to 1.6 billion. Plus the depreciation and the financial decay of book value per share. Ladies and gentlemen, looking at cash at the beginning of the period versus cash at the end of the period, Q4 2024, they went from $1 billion to $763 million. Q1, they went from 763 to 693 million. If we were to analyze the cash that dropped in Q1 2024, they went from 1540 minus 21286. They dropped $255 million of cash in Q1. Ladies and gentlemen, for the same quarter, Q1 2025, they dropped 763 minus 693. They dropped 70 million in cash. This is an improvement. It shows operational efficiency in the fact that last year, 12 months ago, they dropped approximately $254 million in cash versus this quarter, they dropped $70 million in cash. So that is a very big improvement. So let's calculate this improvement. If someone goes from losing $254 million in cash all the way to losing $70 million in cash, if someone from Q1 2024 loses $254 million in cash, then in Q1 2025, they lose $70 million in cash. What is the overall improvement? I'm talking about the percent improvement. I'm doing a couple things at the same time, as this is a live.
Cash in the period.
All right. They improved by 72%. Now, hold on to that number. Let me think. Regarding the enhanced AI analysis, look back at further segmentation of code and implement the change regarding quarter-over-quarter analysis on a quarterly basis. Make that adjustment. And 6 months out, make the adjustment versus foreign currency exchange. These are future updates that I'm going to be rolling out. I take documentation as I get ideas during the live, as I'm the one building this, right? All right. So with that, if you were to analyze this cash in and cash out, let's look at Q2. If we take the same improvement of 375 million and we go ahead and give it a 72.44% improvement, again, this is negative 375 million. What would be the number? So the net loss would be approximately $103 million. So $103 million of net loss. Now here's the problem. They're estimating positive EBITDA, but EBITDA does not mean net income, which is accounting by normal metrics, GAAP. It is a non-GAAP metric analysis, which is non-accounting principles, right? So from that, interesting, we have to see how it is. But you know, if it can be better than 103, then that'll be really good. So let's go and see 103. It's still a lot of money, guys. 103. Hopefully, it's you know, it's still an improvement. It's still an improvement, but because remember the net cash loss. If you look, so how do I explain this to you? If you look at net income, Q2 dropped 92, but their cash. The question is, why did the cash drop? So we could be safe, and we can say we got a depreciation because it went from 109 to 85. That's pretty good. So still a lot ways to go, but we could. Let's be safe. We'll call it negative 50. How about that? Let's say negative 50. A bit safe. Okay. Let's take a look at equity. 645 minus 50 is 595. Book value, equity, outstanding shares. Okay. Please go ahead and take 595 million divided by 723.54 million. You get 82 cents. 82 cents. Now, again, I think that, if they lose 50 million next quarter, that's 52 cents, that's 82 cents. So this will be 82 cents. But if they lose more than 50 million, it'll be, book value will be a lot, less than this. So that's what we're going to have to monitor, unfortunately. Right. So there's that. So now let's go ahead and let's go back to the page here. And actually, wait. Let's open up what analysts are thinking. We could do it both ways. Kind of interesting. They're talking about stock futures leaping, but they haven't updated. Interesting. All right, let me think. Open. Let's look at analysis. So they're expecting them to grow in 2026. So that's actually interesting. There's about 10 analysts that think that. So this could be bullish. And you can see here the average. Now, again, we have our own data. This extends only to 2026. They only give you 2026 because they don't want retail investors to win. We want retail investors to win. So we look at earnings. Somebody help me. Analyst estimates. There it is. Okay. Let's look up net income real quick. Unfortunately, they're thinking that net income is going to be negative. And again, I don't believe in analysts. I think analysts are wrong. A good way to calculate this is to see the quarterly and to see if they're actually correct. Yeah, it looks dangerous. Based off of this transition and based off of seeing this, if these analysts are correct, there's a high probability, ladies and gentlemen, that this stock will undergo a reverse stock split. If they don't become profitable. If they don't become profitable, they will have to undergo a reverse stock split. Okay, now, assuming if they end up going to profitability and they do have a potential business turnaround, let's go ahead and look up annual. Let's go ahead and look up, so 5169. So if we take 5169 multiplied by 5%, we get 258. We go ahead, put 258, and we put a growth rate of, interestingly, what these folks are doing, 20%. Currently, it's not growing that. So, I just am a bit uneasy with this, guys. So it's a bit too high for me. Let me calculate the. Let me think. Let me calculate this here. So we got 642. Let me just calculate my own. So I have a calculator here. We're just going to calculate, okay? 6426.62 minus 5169.818 divided by 5169.818. Yeah, looks like analysts are thinking 24%. Let's see what they say here again. Double check. Yeah. Okay. All right. All right. We'll go ahead and use 20%. Ladies and gentlemen, let's see. So based off of this intrinsic value calculation, if they can turn the business around, we could see a base case of $11.69, a recession case of $4.60, a bear case of $8.76, a base case of $11.69, and the best case of $16.67. If we go ahead and exit the put in the base case and activate our advanced matrix, we get a intrinsic value range of $8.10 to $17.78. If we activate our classic scenario mode, these are the ranges: $4.60 all the way to $16.67. But we have a problem. We are assuming that they are going to be a free cash flow of $258 million. They are not. And we're assuming a high growth rate. But if for other people out there, if they don't end up reverse stock splitting, if there's a lot of ifs, right? Again, Warren Buffett doesn't like to invest in ifs. But Peter Lynch says if they can turn around, and if you can see a turnaround, then you could see stock prices like this. Now, again, personally, I'm a wait and see. Once I see that there's a turnaround here, then we could talk money. Then I can go ahead and pull some more of my 15 million and allocate some to this, and potentially add another million to the public portfolio to showcase how the job is done. But the problem is, as of right now, I do not see a path. They have to prove it to me. I have to see a path to profitability and to free cash flow positivity. I don't see that now. But if the path exists and they can create a positive business model, then ladies and gentlemen, by far, this is incredibly undervalued. It is an undervalued stock. But the problem is institutional ownership are decreasing. Why are they slowing down? You saw it. If you haven't seen it, watch the whole video, right? There's a lot of data here, okay? And book value is going down. So they need to show me a business turn around. All right. Let's see what else I have to say. All right. We could go ahead and look at the generative AI for the section regarding earnings. Watching, would you say this is the most in-depth video for OpenDoor? Could you argue? Could I make that argument or no? For individuals that appreciated our due diligence, our research, please don't forget to subscribe, as we are a grassroots startup that is wanting to democratize and essentially level out the playing field for retail investors. Unfortunately, a lot of people out there like Chamath, palihapitiya, unfortunately did not communicate effectively to retail investors, or unfortunately misled retail investors to believe that this company was going to be profitable anytime soon. And if Chamath has any, and I know you watch his videos, if you have any argument of what I have to say, I would love to debate you, and go ahead and tag me on Twitter. At the end of the day, based off of this conjunction here, what we basically did, it's a wait and see. It's a wait and see. Yeah, that's about it. That's all I have. All right, ladies and gentlemen, for all the folks that want access to the same software that I use, the same software that's available here, one-time payment, lifetime access. This is one of the best platforms out there for retail investors. We have, I would say, a 99% satisfaction, right? Minus Clover Dog, right? He was not satisfied, right? We have a 99% satisfaction with our members. Our members are happy. We have excellent customer service, and we provide the best possible institutionally graded data at your fingertips. There's no guesswork here. If you're flying your portfolio like a plane, you need a GPS, and we are the best GPS that exists for retail investors in today's stock market. I appreciate all of you for tuning in. God bless you, and I will see you on the next one.